This fall, the brightest minds in finance will flock to Florida for a weekend that will change your life, with insights from the brightest stars in the financial universe and an event that will bring them all together. Presenting the first annual T3 Live Finance Festival at the Mayfair Hotel and Spa in Coconut Grove, Florida, for a weekend you'll never forget and memories that will last a lifetime. The Finance Festival, a Todd Harrison production, brought to you by T3 Live and TradeStation. A portion of the proceeds to benefit the Ruby Peck Foundation for Children's Education and the Crohn's and Colitis Foundation of America. Friday, November 6th to Sunday, November 8th, 2015. Bring your spouse, tell your friends, make some noise, and take charge of your financial future. It's gonna be nuts. Space is limited, so act fast.
This is Jeff Cooper with the Daily Recap for September 21st. I'm Jeff Cooper, author of the Daily Market Report. Well, Thursday's bearish reversal on Fed Day led to Friday's breakaway gap below the 50-period moving average on the hourly basis. Here you can see bearish train tracks on Thursday after the Fed announced they were not going to, in fact, raise interest rates, followed by Friday's breakaway gap to the downside. And here we see Monday's back test of this 50-period moving average, which basically has defined the action since the August 24th crash low, Black Monday, August 24th. And here you can see we're basically coming into the apex of another triangle with a rising trend line from September, defining what looks like last-ditch support right around this 1953 level, or 195 on the SPY. Now, why is 1953 important? Because on what W.D. Gann referred to as the square of 9 chart, it's not important what that exactly is. We don't have the time to go into explain it here, but suffice to say that it's a way to measure a price movement and time movement, not just on a linear basis, but on a logarithmic basis. In any event, 1953 represents 180 degrees up from the August 24th crash low of 1867, while it also represents 180 degrees down from the May all-time intraday high of 2134 S&P. So this level, 1953 or 195.30 SPY, roughly cuts through the middle of the pennant carved out by the S&P and SPY since that August 24th low. Now, while 1953 held Friday, we went down to 1953 on the S&P on Friday and closed at 1958, I think it was. So while that level held Friday and today could have simply been a pause day following Friday's large sell day, with this morning's early spike basically backtesting and slightly Pinocchioing the 50-period MA on the hourlies. This brings the market to an interesting inflection point right on the autumnal equinox, or what is often referred to as Gann Day. Why? Well, at the end of July in my report, I mentioned that legendary trader W.D. Gann claimed that capital and commodity markets tend to top on or around September 22nd, more often than any other date of the year. I assume these turns he was referring to could be either primary highs or pivot highs. For example, gold and silver stocks made an all-time bull market high on September 22nd, 1980. In 1929, while the DJIA, the Dow Jones, peaked on September 3rd, the last stock index to make its then all-time high, the Dow Jones Utility Average, did not do so until the autumnal equinox on September 21st, 1929. Interestingly, September 19th, right near the autumnal equinox, was the pivot high prior to last October's uh, plunge, October 2014. Um, so it looks like we're at an inflection point here. We could have had a pause day, a break tomorrow of this trend line, coincident with 1953 and 195 SPY, will trigger a rule of four sell, which is a break below either lateral, horizontal support, or angular support, which in this case would be the instance. So if that's going to happen this week, then it looks like a new leg down following a 3-week retracement is on the table. In summation, uh, today was kind of a throwaway day, kind of a narrow range day. But interestingly, the bond market got hammered with rates up. One can only imagine what would have happened if the Fed had actually raised rates. Did they miss a big opportunity? If so, all hell could be on the verge of breaking loose, with the S&P on the cusp of a possible new leg down, which in the bull case, that scenario would be an undercut or test of the late August lows as occurred in the last big correction in in August, October 2011. The bear case would be that a decisive break through the August 1867 lows on the way to a possible backtest of the 2000 and 2007 peaks at around 1570 to 1600. That's it for today. Good luck out there.